But gold and silver are going to go a lot higher. I feel very comfortable with that. There are multiple drivers, and I'll kind of go through them one by one. Yeah, we get 5,500 in about a heartbeat. I was watching the ticker, we're going to get to 5,000. Of course, I knew we would, but, when it's 5,000, then I think I went to sleep and woke up. It was 5,500. So I was like a 10% drop, literally in 2 days. So, a little pullback's normal. Hedge funds, I always say hedge fund traders don't care about gold, silver, or coffee beans. They just trade. And so if you're a trader and you do a leverage bet on gold and it goes up 10% in 3 days, you probably want to get out of the trade and, mark it up towards your 2026 bonus. So that kind of volatility is normal, but it doesn't really tell us where to peak or anything of the kind. With that said, so what are the drivers? There are several. One is central bank demand. It's, we've talked about that before, but it's a big deal. From 1970 to 2010, central banks were net sellers of gold. Different central banks at different times, believe it or not, in the 1970s, even after Nixon suspended the convertibility of dollars for gold, the U.S. continued to sell gold. We sold about 1,000 tons over the course of the 1970s, got us from 9,000 tons in 1971 to about a little over 8,000 tons in 1980. We got the UK to do our dirty work. There are really technical reasons why the U.S. has not sold any gold since 1980. Probably don't have time to go into them. They're legal and has to do with, first the Fed took the gold from the banks, but in the 1930s, the Treasury took the gold from the Fed. So they keep stealing it between themselves. But there are reasons to believe that, the U.S. has not sold any gold since 1980. You sell a little bit to the Denver Mint for coinage and get some more, but they maintain that official level the whole time. There are reasons to believe that the U.S. cannot sell, not only is not a seller, but cannot sell legally. So put that to one side. The UK sold about a third, almost half of their gold in the late 1990s, 1998, 1999. They weren't very savvy traders. They sold at $250 an ounce, not $2,500, but $250 an ounce. Practically gave it away. That was Gordon Brown was the Chancellor of the Exchequer. You should see him around London and the Red Fort or different restaurants. So that's known as Brown's bottom. He managed to pick the bottom, a 30-year bottom of the market. He picked it and sold the gold. But even in the 2000s, Switzerland sold 1,000 ounces. 1,000 metric tons. Not ounces, 1,000 metric tons. And then there was an uproar in Switzerland. There was a referendum. It failed, but the people in Switzerland were to the point where they wanted a referendum saying that the Swiss National Bank could not sell any more gold. The referendum failed slightly, but the message was sent, and they have stopped selling gold ever since. That brings us to the IMF. The IMF sold 400 tons in 2010. Looks like 200 or so went to India. They never disclosed where the rest went. I'm pretty sure it went to China. But that was it. That was it for large sales by the Western central banks. Since then, central banks have been net buyers. Now, it's not the same central banks. The big buyers have been Russia and China. Russia went from 600 tons in 2009 to about 2,700 tons today. That's, they quadrupled their gold holdings. By the way, just as a quick aside, that's a big reason why U.S. sanctions on Russia in connection with the Ukraine war have failed, because they can never starve Russia reserves. Because Vera Nabiullina, who's the head of the Central Bank of Russia, I always say she's the only central bank in the world who really knows her job. She put 25% of Russia's reserves in physical bullion. And at the start of the war in Ukraine in 2022, Russia had about $600 billion in reserves, but 150 billion of that was in gold, physical bullion. The U.S. couldn't touch it. The U.S. and Europe conspired to steal about 200 billion of Russian reserves in the form of treasury notes. Russia had treasury notes, they had gold, they had some other instruments, some euro-denominated notes, but it was mostly treasury notes and gold. And the U.S. and others tried to steal them. They're in a custodian in Brussels called Euroclear, which is one of the biggest custodians in the world. They have $47 trillion of assets in custody. They don't own it, but they're the custodian, registrar for all that. So that was supposed to be like this death blow for Russia. We froze the reserves. Then we were going to steal them use them as collateral for a loan to Ukraine. So Russia's lawfully acquired assets are being used as a collateral for a loan to pay Ukraine to fight Russia. That's how crazy this whole thing was. It gets worse, but anyway, Russia's going to win the war. They'll eventually get those assets back. But my point is, why was that not a kind of a death blow to Russia's financial position? Well, a number of reasons, but part of it was because they had so much gold. Ironically, because of the effort to steal the Russian assets, central banks around the world, not just Russia, but others, started buying more gold, and it drove the price of gold up. So Russia has, do a quick estimate, has almost tripled the value of their gold reserves in dollar terms because of the run up in the price of gold, because the U.S. tried to steal the dollar assets of Russia in Euroclear. So what we did on the one hand by freezing and trying to steal assets, we gave an enormous $100 billion gift to Russia in the form of higher gold prices. So I think I have to do the math, but my estimate is they've made as much on gold mark to market as they lost in these assets stuck in Brussels. So, and I teach this. I teach financial warfare at the U.S. Army War College. So I try to explain this to the students. They're pretty smart. It's a hand-picked class, about 13. They're all kind of future big brains, or future high-ranking big brains, I should say. But and I got a lot of pushback on it. But when you explain it to people, they're like, "Oh yeah, that was kind of a dumb move." What the U.S. did. China, same period, 2009 to today, China's gold reserves have gone from about 600 metric tons to closer to 3,000 metric tons. They very likely have a lot more. They're non-transparent. Well, the People's Bank of China is transparent to a point, but they have another sovereign wealth fund called the State Administration of Foreign Exchange, or SAFE, which holds foreign exchange, including gold, and is completely non-transparent. So we don't know exactly how much gold China has, but there's good reason to believe that this 3,000 tons they report could very well be closer to 6,000 tons or more. So there's China. But you have other buyers: Kazakhstan, Vietnam, Mexico, even the Philippines, India, Japan, which is an ally of the United States, increased their gold reserves. So that does a couple of things. And obviously, it tends to drive the price up, not to stratospheric levels, but to drive it up. But on the other side of that trade, or that equation, is gold output has been constant, around 4,000 metric tons per year worldwide. Now, it hasn't been crashing, and I'm not saying peak gold. You can still find gold, but it's getting more and more difficult. Lower levels, lower grades. I invest in some gold mines, so I'm not a geologist, but I have some familiarity with the kind of the economics of the gold mining industry. But, economics 101, first week, supply and demand. When supply is constant and demand is going up, the price goes up to clear the market. So that's one of the drivers. And it's really attractive for gold investors. Like, by itself, it doesn't mean gold goes to the moon. But what it does mean is you have a kind of informal floor under the price of gold. No guarantees. But if the price goes down a lot, central banks, that's when they come in and nibble, because they're pretty savvy buyers. So you have what I call an asymmetric trade, where you have all the upside, but limited, in my view, limited downside, because the central banks are putting a floor under the gold. So that's a high-level dynamic. At the same time, when the U.S. and Europe froze those Russian assets, other sovereign wealth funds and central banks around the world are looking at this, whether it's Taiwan or Japan or Saudi Arabia. Some of these have, if not $1 trillion, close to $1 trillion in reserves. They're saying, hey, what if the U.S. doesn't like something I do? What if, they want to treat me the way they treated Russia? Maybe I ought to buy more gold. And they are. I'm not saying they're dumping treasuries. The debasement trade, the narrative from Wall Street is, the world's dumping treasury securities. They're dumping dollars. They're getting out of the dollars. The dollar's over, buy gold, et cetera. I agree with the buy gold part, but everything else I just said is false. And we have data to back that up. The Treasury has a monthly report. It's called the TIC report, TIC, but basically it's a very simple spreadsheet. and they show all the major countries around the world, and then they show how much gold they have, how many treasury securities they have. I misspoke. How many treasury securities they have, and that's been fairly steady. I'm not saying the world is loading up on treasuries, but they're definitely not dumping them. That part of the narrative is false. And people talk about the dollar being the global reserve currency. Well, currencies are not global reserves. Global reserves are securities. And people don't make the distinction between a currency and a security. Now, the security is denominated in the currency, of course, and that's really what people mean. But it's not like the central banks have pallets of $100 bills in the basement. They don't. They have treasury securities, 2-year notes, 5-year notes, 10-year notes, short-term bills, all the different maturities of treasury securities. And they are not dumping them. If they sell any, and sometimes they do, it's more a sign of dollar strength than dollar weakness. And the reason for that is, why would you sell your treasury securities? Well, it means you need cash. Because treasury securities are not, as I just explained, they're not cash. If you want cash, you got to sell the treasuries, get the cash. What is China doing with the cash? They're propping up their banks and propping up their currency. That's not a sign of dollar weakness. It's the opposite. It's a sign of dollar scarcity and weakness in the yuan or the Japanese yen, as the case may be, and all these other currencies. So even to the extent that some of the countries sell a little bit of treasuries, it's more because they're desperate for dollars, not because they're dumping dollars.